Question 1. Which of the following best explains a key advantage of tax-deferred growth in an annuity? A. It allows gains to compound without immediate taxation, potentially increasing the overall value until withdrawals are made. B. It guarantees that all gains within the annuity are tax-free upon withdrawal, regardless of age. C. It eliminates the need for any taxes, even on withdrawals, if the annuitant is under 591. D. It applies only to variable annuities, not fixed or indexed annuities. Answer A. Explanation. Tax-deferred growth allows gains within an annuity to compound over time without being taxed immediately. This advantage can lead to higher potential growth because funds that would have been paid in taxes continue to earn a return. The taxes are deferred until the annuitant takes distributions, at which point they are taxed as ordinary income. Option B is incorrect because withdrawals from annuities are subject to taxation based on the gains portion, especially if taken before 591, which also typically incurs a 10% penalty per IRS rules. Option C is incorrect as taxes are due upon withdrawal and the tax-deferred nature does not imply a complete tax exemption. Finally, option D is incorrect because tax deferral applies to various types of annuities, including fixed, indexed, and variable annuities. Question 2 scenario, MS. Parker, aged 65, owns a fixed indexed annuity that credits interest based on an index performance but with a cap on maximum returns. This year, her annuity has a cap of 7%, a floor of 0%, and a participation rate of 80%. If the index increases by 10% for the year, what would be the effective credited rate applied to MS? Parker's annuity: A. 8%, B. 7%, C. 6%, D. 5%. Answer C. Explanation. In a fixed indexed annuity, the credited rate depends on the cap, floor, and participation rate. Since the participation rate is 80% MS, Parker's credited interest rate would be calculated by applying this rate to the index's 10% gain. 10% x 0.8 equals 8%. However, the annuity has a cap of 7%, so the effective credited rate will be limited to this cap, meaning MS. Parker will be credited with 7% interest, not 8%. Option A is incorrect because it does not account for the cap. Option B is correct because it reflects the cap applied due to the annuity's terms. Option D incorrectly applies the participation rate without considering the cap. Question 3. Which of the following situations would most likely be considered unsuitable for a senior client under Minnesota's suitability standards for annuity transactions? A. Recommending a deferred annuity with a long surrender period to an 85-year-old client with limited liquidity needs. B. Recommending an immediate annuity to a 65-year-old client seeking guaranteed lifetime income. C. Advising a 70-year-old client to transfer from one deferred annuity to another with similar surrender terms for low fees. D. Suggesting a variable annuity with risk-adjusted subaccounts to a 60-year-old client who desires high growth potential. Answer A. Explanation. According to Minnesota's annuity suitability guidelines, recommending a deferred annuity with a lengthy surrender period to an elderly client, particularly someone with limited liquidity, may be deemed unsuitable. Seniors are often advised against products that lock up funds for extended periods due to their higher likelihood of needing accessible funds for healthcare or other expenses. Option B is likely suitable as it matches a senior's typical preference for guaranteed income. Option C may be suitable if it reduces costs without extending surrender penalties significantly, though this would need to be evaluated carefully. Option D could be suitable for a client with a higher risk tolerance who seeks potential growth, provided it aligns with their financial goals and risk profile. Question 4. In a fixed annuity, what is the primary risk to the annuitant over time? A. Market volatility. B. Inflation risk. C. Mortality and expense charges. D. Subaccount performance risk. Answer B. Explanation. The primary risk associated with fixed annuities is inflation risk. Fixed annuities provide a guaranteed rate of return, which remains constant over time. However, this fixed rate can lose purchasing power as inflation increases, especially in a high inflation environment, as the value of fixed payments does not keep pace with rising costs. Option A. Market volatility is primarily a concern with variable annuities where returns fluctuate based on market performance. Option C. Mortality and expense charges typically apply to variable annuities rather than fixed annuities. Option D. Subaccount performance risk is irrelevant in fixed annuities as they do not involve market-based subaccounts. Question 5. When recommending an annuity replacement to a client in Minnesota, which of the following steps is required by law to ensure compliance with the Minnesota annuity replacement rules? A. Ensuring the replacement meets the same tax-deferred benefits as the previous annuity. B. Conducting a full suitability review and providing required disclosures on the new annuity. C. Making sure the new annuity has lower fees than the original product. D. Confirming the new annuity has a higher participation rate than the original product. Answer: B. Explanation. Under Minnesota's annuity replacement rules, an agent must conduct a full suitability review to ensure the new annuity is suitable based on the client's financial situation, goals, and risk tolerance. The agent must also provide required disclosures about the replacement, explaining any differences, benefits, or potential disadvantages in comparison to the original annuity. Option A is incorrect because tax deferral is common across most annuities and not the sole criterion for replacement. Options C and D are also incorrect because fee reduction or participation rate improvement alone are insufficient without a comprehensive suitability assessment. Question 6. Scenario: Mr. Roberts, age 58, wants to make a partial withdrawal from his deferred annuity to cover unexpected expenses. His contract includes a surrender period and he plans to withdraw only part of his annuity's accumulated value. What will likely apply to Mr. Roberts' withdrawal? A. Ordinary income tax and a 10% penalty since he is under 591 WO. B. Capital gains tax and surrender charges. C. Only a surrender charge as he is not annuitizing the contract. D. Only ordinary income tax as he is making a partial withdrawal. Answer: A. Explanation. For partial withdrawals from a deferred annuity before age 591 WO, the IRS imposes ordinary income tax on the taxable portion, usually the earnings, and an additional 10% early withdrawal penalty. Mr. Roberts will also incur any applicable surrender charges if he withdraws during the surrender period. Option B is incorrect because annuities are subject to ordinary income tax on earnings, not capital gains tax. Option C is incorrect as the 10% penalty applies to non-annuitized withdrawals before age 591 WO. Option D is incorrect because the IRS penalty applies due to his age. Question 7. What is the difference between accumulation units and annuity units in a variable annuity? A. Accumulation units are purchased before the annuity phase, while annuity units are used to calculate payments during the payout phase. B. Annuity units can be transferred to other accounts, but accumulation units are not. C. Accumulation units are fixed, while annuity units vary with market performance. D. Accumulation units represent the interest rate earned, while annuity units represent the account value. Answer: A. Explanation. In a variable annuity, accumulation units are acquired during the accumulation phase and represent the investor's share in the sub-accounts. Once the annuitant transitions to the payout phase, these accumulation units are converted to annuity units, which determine the periodic payments based on their current value. Option B is incorrect as neither type of unit is transferable to other accounts. Option C is incorrect. Accumulation units can vary in value based on investment performance, but annuity units are used in the payout phase to calculate payments. Option D is incorrect. Accumulation units are not directly tied to interest rates, but rather the performance of chosen investments. Question 8. In Minnesota, what is the required free look period for annuities during which a policyholder can review the contract and cancel it without penalty? A. 30 days from the contract's effective date. B. 15 days from the contract's receipt date. C. 10 days from the contract's effective date. D. 45 days from the contract's receipt date. Answer: B. Explanation. Minnesota requires a 15-day free look period for annuities. This period allows the policyholder to review the annuity contract terms and cancel it within 15 days of receiving the contract if they are unsatisfied with a full refund. Option A is incorrect because 30 days is not mandated under Minnesota law for annuities. Options C and D are incorrect as the free look period is neither 10 days nor 45 days under state requirements. Question 9. Which of the following best describes the concept of the exclusion ratio for annuity payments? A. It is the ratio of the annuity's earnings that are tax exempt in each payment. B. It is the proportion of each annuity payment that is considered a return of principal and thus not taxable. C. It is the percentage of the annuity's total value that is taxable as capital gains. D. It is the method used to calculate the annual yield of a variable annuity. Answer: B. Explanation. The exclusion ratio is used in non-qualified annuities to determine the non-taxable portion of each annuity payment that represents a return of principal. The remaining portion of each payment is taxed as ordinary income. Option A is incorrect, as the exclusion ratio applies to principal return rather than earnings. Option C is incorrect because annuities are taxed as ordinary income, not capital gains. Option D is irrelevant because the exclusion ratio is unrelated to yield calculations for variable annuities. Question 10. A client in Minnesota wants to invest in an indexed annuity with a cap of 9% and a participation rate of 85%. If the underlying index gains 11% in a given period, what will be the credited rate for the annuity? A. 9%, B. 11%, C. 8.5%, D. 7.65%. Answer A. Explanation. To calculate the credited rate, the participation rate of 85% is first applied to the 11% index gain. 11% x 0.80 equals 9.35%. However, because the annuity has a cap of 9%, the credited rate is limited to this cap, meaning the client will only be credited 9% despite the index's gain. Options B and C incorrectly apply the participation rate without considering the cap. And option D calculates the participation rate correctly but overlooks the cap restriction. Question 11. Which of the following types of annuities provides a guaranteed minimum interest rate and protection against market losses while allowing potential for market-based growth? A. Variable annuity. B. Indexed annuity. C. Immediate annuity. D. Fixed annuity. Answer B. Explanation. An indexed annuity offers a guaranteed minimum interest rate and links returns to a stock market index, providing the potential for market-based growth while protecting against market losses. Variable annuities, option A, do not offer market loss protection as their values fluctuate based on investment performance. Immediate annuities, option C, begin periodic payments immediately but typically don't include market-based growth potential. Fixed annuities, option D, provide a guaranteed interest rate but no market-based growth. Question 12. Scenario MS. Franken, a 68-year-old retiree in Minnesota, is considering purchasing a variable annuity with a guaranteed lifetime withdrawal benefit or double rider. She is concerned about outliving her savings. Which feature of the GLWB rider would be most beneficial for her? A. The ability to withdraw her entire annuity balance without fees. B. The guarantee of a minimum income for life regardless of market performance. C. The flexibility to increase withdrawals during high market returns. D. The option to increase her principal based on inflation adjustments. Answer B. Explanation. A guaranteed lifetime withdrawal benefit double rider provides a minimum lifetime income which can give MS Franken peace of mind that she will not outlive her income even if the annuity's underlying investments perform poorly. Option A is incorrect as the GLWB does not eliminate withdrawal fees but ensures a lifetime income. Option C is incorrect as withdrawals are typically based on a fixed percentage of the guaranteed income. Option D is not a standard feature of GLWB riders. Question 13. In a Minnesota annuity contract, what is the surrender charge period? A. The time period during which the annuity can be cancelled without penalty. B. The period in which withdrawals from the annuity are subject to fees. C. The time after the death of the annuitant when beneficiaries receive funds. D. The period in which the annuitant's premium is guaranteed to earn a fixed rate. Answer B. Explanation. The surrender charge period is the period during which early withdrawals from an annuity are subject to surrender fees. This period can vary depending on the contract terms, and fees decrease over time until they are eliminated after the period ends. Option A describes a free look period. Option C refers to the death benefit process, and option D is unrelated to surrender charges. Question 14. When discussing an annuity with a client in Minnesota, what must an agent provide as part of the suitability review process? A. Detailed information about all other investment options available. B. A comparison of all annuities available in the market. C. An analysis of the client's financial status, objectives, and risk tolerance. D. A list of annuity products the agent owns personally. Answer C. Explanation. As part of the suitability review, the agent must assess the client's financial situation, objectives, and risk tolerance to ensure that the annuity product aligns with the client's needs. Options A and B are not required, as agents are only required to review products they recommend, not the entire market. Option D is not relevant to the suitability review process. Question 15. What happens if a Minnesota resident withdraws funds from an annuity before age 591, where only the earnings are subject to income tax and a 10% penalty? B. Only the principal is subject to income tax and a 10% penalty. C. The entire amount withdrawn is subject to income tax and a 10% penalty. D. The withdrawal is only subject to the insurance company's fees. Answer A. Explanation. Withdrawals from an annuity before age 591 were subject to ordinary income tax on the earnings portion as well as a 10% early withdrawal penalty on those earnings. Principal withdrawals are not penalized by the IRS. Option B incorrectly applies tax and penalties to the principal, and option C incorrectly assumes the penalty applies to the entire amount. Option D omits the IRS penalties and tax implications. Question 16. How does the floor in an indexed annuity benefit the policyholder? A. It limits the maximum earnings. B. It guarantees that returns will not fall below a minimum rate. C. It allows for higher participation rates. D. It provides a fixed interest rate for life. Answer B. Explanation. The floor in an indexed annuity guarantees that the policyholder's return will not drop below a certain minimum rate, protecting against losses in years when the linked index performs poorly. Option A is incorrect, as the floor does not limit maximum returns. It caps or participation rates might. Option C refers to participation rate features, and option D describes fixed annuities. Question 17. Under Minnesota law, an annuity replacement is subject to which of the following requirements? A. The insurer must provide a side-by-side comparison of fees and benefits. B. The agent must obtain a signed statement from the client acknowledging the replacement. C. The client must hold the new policy for a minimum of 1 year before changing again. D. The replacement policy must have lower premiums than the existing policy. Answer B. Explanation. In Minnesota, when an annuity replacement occurs, the agent is required to obtain a signed acknowledgement from the client confirming their understanding of the replacement. This helps ensure transparency. Options A, C, and D are not specific legal requirements for replacement transactions in Minnesota. Question 18. What is the main difference between a qualified and a non-qualified annuity? A. A qualified annuity has no surrender charges, while a non-qualified one does. B. Contributions to a qualified annuity are typically made with pre-tax dollars, while non-qualified are with after-tax dollars. C. A non-qualified annuity offers a higher cap rate than a qualified annuity. D. Only a qualified annuity provides a guaranteed minimum rate of return. Answer B. Explanation. Qualified annuities are funded with pre-tax dollars and typically part of a retirement plan like an IRA, meaning taxes are deferred until withdrawal. Non-qualified annuities are funded with after-tax dollars, with tax-deferred growth but no upfront tax deduction. Options A, C, and D are not accurate distinctions between qualified and non-qualified annuities. Question 19. What purpose does the participation rate in an indexed annuity serve? A. It determines the minimum guaranteed rate of return. B. It specifies the percentage of the index gains that will be credited to the annuity. C. It limits the annuity's exposure to market losses. D. It sets a fixed rate of return for the life of the contract. Answer B. Explanation. The participation rate in an indexed annuity is the percentage of the index's gains that will be credited to the annuity, determining how much of the positive index movement will apply to the contract's value. Options A and D describe features of fixed annuities, while option C is incorrect because participation rates do not protect against losses. The floor does. Question 20. When is an annuity contract generally considered unsuitable for a client? A. When the client is looking for immediate access to funds. B. When the client is under 35 years old. C. When the client has no other retirement savings. D. When the client has a high risk tolerance. Answer A. Explanation. Annuities are generally unsuitable for clients who require immediate liquidity, as they are designed for long-term income with potential surrender charges and penalties for early withdrawals. Option B is incorrect because age alone does not determine suitability. Option C could be incorrect, as some clients may need an annuity even without other retirement savings. And option D is incorrect, as high risk tolerance does not inherently make an annuity unsuitable. Question 21. Which of the following is a key benefit of a fixed annuity? A. Higher potential returns linked to the stock market. B. Protection of principal with a guaranteed interest rate. C. Ability to adjust payments based on inflation rates. D. Flexibility to withdraw funds without penalties. Answer B. Explanation. A fixed annuity guarantees a set interest rate, providing stability and protecting the principal. Unlike variable or indexed annuities, fixed annuities do not have market-based returns. Option A. Option C is incorrect, as most fixed annuities do not adjust for inflation. Option D is also incorrect, as fixed annuities typically impose penalties for early withdrawals during the surrender charge period. Question 22. In Minnesota, which of the following disclosures is required when recommending an annuity replacement? A. A comparison of the mortality and expense charges between the old and new annuities. B. A notice to the client that a replacement may not be in their best interest. C. A written waiver of all surrender charges on the old annuity. D. A verbal explanation of the new annuity's premium structure. Answer. B. Explanation. Minnesota regulations require that clients be informed that an annuity replacement may not be in their best interest, as the replacement may involve fees or charges that affect the client's investment. Option A is not a specific requirement. Option C is incorrect, because a waiver of surrender charges is not typically required, and option D is incorrect, as a verbal explanation alone does not meet disclosure requirements. Question 23. A Minnesota resident who purchased an annuity discovers they need to withdraw funds before the surrender charge period ends. What are they likely to incur? A. Only income taxes on the withdrawn amount. B. A surrender charge and possibly an IRS early withdrawal penalty if under age 591 WO. C. Only a reduction in their future payout amount. D. No penalties, as annuity withdrawals are allowed without charge in Minnesota. Answer. B. Explanation. If an annuity withdrawal occurs before the end of the surrender charge period, the client may face both a surrender charge from the insurance company and an IRS penalty if they are under 591 WO. This rule applies to most annuities in Minnesota and other states, as early withdrawals are discouraged through these fees. Question 24. Which of the following accurately describes an immediate annuity? A. It accumulates interest over a set period before starting payouts. B. It begins providing payments to the annuitant shortly after purchase. C. It has a flexible premium payment structure. D. It links payout amounts directly to stock market performance. Answer. B. Explanation. An immediate annuity starts payments shortly after it is purchased, typically within a month to a year. Option A is incorrect, as it describes a deferred annuity. Option C is inaccurate, since immediate annuities are typically funded with a single premium, and option D is incorrect, as immediate annuities are not typically tied to the stock market. Question 25. In a Minnesota annuity contract, what is the purpose of a free look period? A. It allows the policyholder to earn interest before making a final commitment. B. It enables the policyholder to cancel the contract without penalty. C. It permits early withdrawals without surrender charges. D. It ensures a guaranteed interest rate for the first year. Answer. B. Explanation. The free look period allows a policyholder to review and, if desired, cancel an annuity contract without penalty within a specified period, usually 10 to 30 days after the policy is issued. Option A is incorrect, as the free look period does not relate to earning interest. Option C is incorrect because it doesn't permit withdrawals, and option D is unrelated. Question 26. Which annuity option would be most suitable for a client concerned about inflation? A. Fixed annuity. B. Indexed annuity. C. Variable annuity with a guaranteed minimum income rider. D. Immediate annuity. Answer. B. Explanation. An indexed annuity provides potential for growth linked to an index, which can help counter inflation. Fixed annuities, option A, have a guaranteed interest rate but may not keep pace with inflation. Variable annuities with a guaranteed minimum income rider. Option C, provide stable income but may still not offer inflation adjustments. Immediate annuities, option D, do not typically adjust for inflation. Question 27 scenario. Mr. Taylor, age 55, wants to invest in an annuity that offers him tax-deferred growth and potential for higher returns without risking his principal. Which annuity option would best suit his needs? A. Variable annuity. B. Fixed annuity. C. Indexed annuity. D. Immediate annuity. Answer. C. Explanation. An indexed annuity offers tax-deferred growth, potential for higher returns linked to an index, and protection of the principal. This combination suits Mr. Taylor's desire for growth potential without risking his principal. A variable annuity, option A, does not guarantee the principal, and a fixed annuity, option B, has limited growth potential. An immediate annuity, option D, is for immediate income, not growth. Question 28. When an annuity is used within a qualified retirement plan, what is the tax treatment of distributions upon withdrawal? A. Only the interest is taxable. B. The entire amount is subject to income tax. C. The principal is tax-free while earnings are taxable. D. Only withdrawals above the original investment are taxed. Answer B. Explanation. In a qualified retirement plan, the entire amount withdrawn from the annuity is generally subject to income tax as contributions were made with pre-tax dollars. Option A applies to non-qualified annuities. Option C is incorrect because both principal and earnings are taxed in a qualified plan. Option D does not apply to qualified annuities. Question 29. What is a typical requirement for an insurance agent in Minnesota when selling an annuity to a client? A. Conduct a financial suitability review with the client. B. Provide a list of alternative investment options. C. Offer a guarantee on future performance of the annuity. D. Secure a waiver for all future policy changes. Answer A. Explanation. In Minnesota, agents must conduct a suitability review to ensure the annuity meets the client's financial needs and goals. They do not need to provide alternative investment options. Option B. Guarantee future performance. Option C. Or secure waivers. Option D. Question 30. What distinguishes a joint and survivor annuity from other annuity options? A. It provides payments to the annuitant for life only. B. It continues payments to the survivor after the primary annuitant's death. C. It pays out a lump sum at the annuitant's death. D. It offers a higher payout than single life annuities. Answer B. Explanation. A joint and survivor annuity provides ongoing payments to the surviving spouse or co-annuitant after the primary annuitant's death, which is a key feature distinguishing it from other types. Options A and C are incorrect as they describe different payout structures, and option D is inaccurate as joint and survivor annuities often offer lower initial payouts than single life annuities due to the longer potential payout period.